John Rao is going to be our speaker. John spoke at our last webinar. He's not speaking today, so I will apologize to anyone that was expecting to hear him, and unfortunately you're stuck with me. This is the fourth of these webinars regarding navigating the loan modification process. In going through the attendees, I see a lot of names of folks that have been on for the first 3 calls. That's great. I also see some names of people who have not been on the calls. If you have not been on the previous webinars and after today decide that you are interested in some of the other materials, you can always send me an email and we can see if we can connect you up with those materials. In addition, I want to make this as practical and as useful for everyone that is on the call as possible. So please, if you have questions as we go, it is in listen-only mode, but you can put your questions into the question box on your screen. We'll try to answer those as we go. We also have Becky Case from our office on the line. She's going to help moderate some of those questions, and she's also going to be presenting in the second half of this webinar. In addition, I know that in the previous webinars we have had some follow-up questions that people have sent either directly to me or to someone else at Empire Justice Center. If you are one of those folks and we have not gotten back to you, I apologize. That is my fault. We've had a number of things come up here in the last few weeks, and we haven't been able to get back to all of them. I promise you that we will respond. So if you have questions regarding today's webinar, please do send them in, knowing that you will get a response. And I apologize for the ones that have not been so timely to date. The first 3 parts of this webinar, we talked about the process of how to apply for loan modification and the different programs that are available for homeowners depending on what type of loan you have. What we're going to focus on today is everything post the initial submission, and that's going to deal with both the modifications, the approval documents, as well as escalations. So first thing we're going to look at is HAMP. For those that have been on all of these webinars, you know that we focused a lot of our attention on the HAMP program. It has become the de facto standard that the first thing that most homeowners will be reviewed for. Most of the banks and servicers in the country do take part in the HAMP program. I'm assuming that folks on the call have a basic knowledge of the HAMP program at this point. So if your homeowner does receive a HAMP modification, they don't receive that permanent modification, of course, right off the bat. What they receive is a 3-month trial plan. Under this trial plan, my understanding is the banks essentially want to see that the homeowner is serious about this modification. They actually can afford the payments. They are going to make the payments. They're going to make them on time, and they're going to make them in full. And if they do that for these 3 payments, theoretically the loan then gets converted to a permanent modification. So as you can see on your screen, this is the letter that the homeowners will receive for the trial period plan notice. Now, what you'll see here in the middle is this shows what their payment is going to be and the due dates that they'll be due on. When a homeowner receives a HAMP trial plan, all they know at that point is what their monthly payment is going to be. What they are not going to receive, they're not going to receive any details on the other terms of what the permanent modification would look like. So they're not going to see what their new interest rate will be if they get converted to a permanent modification. They're not going to see what their new principal balance is going to be. They're not going to see the amount of arrearages that are going to be capitalized in the loan modification. All they're going to see is what that monthly payment is. A couple things on this. Number one, that payment is within pennies of what the permanent modification payment would look like. The idea from the perspective of the overall plan is that if we want to see that the homeowner can afford it, this amount, it wouldn't make sense to change that amount after the fact. So they tie together this payment with what the payment is long term. Beyond that, we don't have any terms, and I know that's frustrating. I know a lot of the clients that I work with have a real hesitancy to take part in a trial plan without knowing what all those terms are. Unfortunately, if you try to follow up with the banks or servicers, typically what you're told, or what I'm told, and the folks from Empire Justice Center, is that that information is not even available to us, is what the bank will say. We can't provide that at this time. Now, if you continue to ask questions and you ask the right questions, you may be able to get some information at this point. For instance, you should be able to get what the unpaid principal balance was before the modification. You also may be able to find out what the total arrearages are. That's the amount the homeowner would need to pay in order to get caught up to current. Those two numbers together, the principal balance and the arrearages, are going to give you an estimate as to what that new principal balance is going to be. Now, it certainly is not going to be exact. There are attorney's fees that most likely will not be included in that figure, and court costs, but at least can give you a ballpark. If the homeowner wants to know at that point, what am I going to owe at the end of the day, you can at least give them a rough estimate of what that number is going to be. But again, this is the way the program is set up, is that all those terms are not available right off the bat. If the homeowner makes those three payments on time and in full, the way the process is supposed to work, and you notice I say supposed to work, is that at that point the homeowner will be converted to a permanent modification. Assuming that process plays out the way it is supposed to, and I know that's a big assumption, and we're going to talk about the issues regarding converting from a trial period plan to a permanent plan in a little while. But assuming that process does go the way it is supposed to, your homeowner will then receive the HAMP final loan modification documents. I just want to go through briefly the documents that they're going to receive. When they get those final modification documents, they will have a cover letter that comes along with it, and it should look something along these lines. These forms are all were put together by the Treasury Department so that they should be consistent from bank to bank. And that's why we have the ability to go through them. It doesn't matter which servicer or bank is doing this modification. All forms should look similar, or if not almost exact. So the cover letter states some basic information that if they need to sign the letter and send it back to them, and here's the date right here as far as when that has to get back to the bank. One tip I will make at this point is that oftentimes what happens with homeowners that I've worked with is that they will get these documents, these modification documents, and the date in which they have to return them is very quick. Sometimes, let's say it's a 48-hour turnaround or a 72-hour turnaround. Oftentimes, the homeowner has a lot of questions regarding some of the numbers that are in this permanent modification. The practice that I have is to contact the bank as soon as I have these documents, or the bank's attorneys. Oftentimes, if you're dealing with the attorneys, you can call the attorneys directly, explain to them that you just received those documents, you are reviewing them with your homeowner, and that it is likely you are not going to have them back by the date in which they had to be back. Almost every time I am able to get the bank to say, or the bank's attorneys to say, well, you know what, you can have X more days. You can have another, they just need to be back within a week, or within the next couple weeks is fine. Oftentimes the date that is on there is not an actual hard and fast date. So there is a little bit more flexibility there, which gives you as the attorney or the housing counselor or the advocate a chance to go through these numbers with your homeowner, make sure the homeowner is comfortable with them. If you have questions about numbers, following up with the bank's attorney or the bank directly to get those answers, because it's important to note, once your homeowner signs this permanent modification, they have essentially reaffirmed that everything in these documents is accurate and correct. So they are obviously they're going to be increasing their principal balance. They're signing on to say that all the fees and costs that are included in this are accurate and correct. It is much more difficult to go back and try to undo a permanent modification and fight fees that were included in there after you've signed it, as opposed to trying to buy a little bit more time and get the questions answered ahead of time. That is what I have found. So I would certainly encourage you, if you need more time, to reach out as soon as you have these and try to get more time from the bank to get those back. The second page of the cover letter is going to give you a lot of the big terms that your homeowner is going to be interested in. New principal balance, the new interest rate, If there's any term extension under HAMP, they can extend that term up to 40 years. So that's where they would put it, is in this next section, term extension. If there is deferral of principal, they're going to list that here. Now, as a way of review, we talked about the fact that the HAMP, in order to modify a loan under HAMP, they go through the waterfall process. First thing they look at is lowering interest rate, and they can go down to a floor of 2%. If they still haven't reached that 31% threshold, they then look to extend the term out to as much as 40 years. If they still haven't hit that 31% threshold, they then begin to look at an interest-free balloon payment. And that's what this deferral of principal refers to. So essentially what happens is a portion of the unpaid principal balance is carved out. It is set aside. It is due and payable at the end of the loan, whether that's the end of the term, the house gets refinanced, or the house gets sold. At that time, that interest-free balloon payment will be due and payable. And that's what this deferral of principal refers to. Principal forgiveness, on the other hand, is just that. This is principal that's being forgiven that does not need to be paid back at any time. As this letter states, there could be income tax consequences related to forgiveness. That debt forgiveness is treated as income from an IRS perspective. There are exemptions currently on the books so that the homeowner will not actually see a taxable, any increase in their taxes. However, I think it's very important that they reach out. You remind a homeowner, if they do have principal forgiveness, to reach out to their tax person, their accountant, whoever that is. If they don't have one, they should get one for this year's taxes to make sure that they don't have any tax issues after the fact. Escrow account is going to tell you how much the escrow portion of the payment is going to be. Under HAMP, they do have a requirement that all loans be escrowed. So if your homeowner was not making escrow payments before, they are going to have to under a HAMP modification. Escrow shortage. Escrow account talks about going forward, making sure there's enough money in the escrow account to pay future taxes and future insurance, homeowners insurance payments. Escrow shortage deals with the fact that it takes, there may be past due amounts that are due in order to get a shortage of their funds in their escrow account that gets them up to the point of having enough in their account. This will be a relatively short-term issue. The highest this can go is up to 60 months, 5 years, which they'll spread this out. What this will mean is during that time frame, your homeowner will have a slightly larger payment. So they're going to tell you in this line here what that amount is. And I apologize for my terrible circles. But your homeowner has the option. They can pay all of that escrow shortage in a lump sum, or they can just have it be a monthly payment spread out over a course of a number of months. Once they complete the payments, if they choose to make a monthly payment, after that term is up, the payment then will be reduced by that amount. So this is the escrow shortage, again, is on top of whatever their regular payment is. The next page, and then they talk about the payment schedule. The payment schedule is included in the loan modification documents, which we're going to look at here in a moment. So here's the actual loan modification documents themselves under the HAMP program. First page, I don't think there's anything really to note. You can obviously read through, and I'm sure many of you have, if you have homeowners that have had HAMP modifications, through some of the representations and covenants. Here on the second page, again, there's a couple things to note. The maturity date is listed here. Again, you want to make sure it matches up. All these sections should match up with what the cover letter said. The new principal balance is listed here. Here is your schedule for the interest rate. So under HAMP, as a way to review, if you lower the interest rate, the way it works is that interest rate is locked in for 5 years. After the 5th year, the bank can increase the interest rate 1% a year, but the highest they can ever go back to is today's current market value, current market rate. So whatever the rate is at the time the modification is done, right now that's somewhere in the 4%. That's the highest the loan could go back to. So this schedule will show you, let's say a loan was lowered down to 2% for the first 5 years. In year 6, they can go back to 3%. In year 7, they can go back to 4%. Because today's current rate is not 5%, in year 8, they would not go back to 5%. For years 8 through 40 in this example, they would be locked in at the 4 point whatever the rate is today. Shows you what the principal and interest payment is going to be, what the estimated monthly escrow payment is going to be, which therefore gives you their total payment. Now, obviously, that monthly escrow payment is just that. It's an estimate. As taxes go up, as homeowners insurance goes up or down, those amounts may adjust slightly. The principal and interest payment should be exact. That should never change under the terms of the modification. I want to point out here on page 3 one important section. I know one of the things that comes up a lot with clients that we deal with is divorce and the issue of if you have spouses that get divorced. Let's say that the husband stays in the house, the wife moves out, and the wife quitclaims that deed to the husband, the ex-husband, and then the ex-husband falls behind on the mortgage and wants to get that loan modified. What oftentimes I know a lot of issues are that if you are not dealing with a HAMP modification, what the banks will come back and say both spouses have to sign off on that modification, even though in the case I'm speaking of, the ex-wife has moved out and has quitclaimed the deed to the husband. Under HAMP, that is not necessary. You'll see here in Section 4A. If the parties are divorced and the property has been transferred from one spouse to the other in the divorce decree, the spouse who no longer has an interest in the property need not sign this agreement. Now, you'll note that the next section, the non-signing spouse may continue to be held liable for the obligation under the loan documents, but they do not need to sign the documents. We have had several cases where we have there's a lot of animosity between the ex-spouses, and so the chances of having both of them sign are very low. In that case, you would not need to have both parties sign. Another thing to point out here in Section D is that if your homeowner has not been having the escrow account, not having their account escrowed, again, it is part of the HAMP program that it is required for them to escrow. So that is that's where that states that. The rest of this, the language in here, I will let you review at your leisure. There isn't anything in here that I think is really very important to point out, or any areas that you can get caught in. And then finally, the signature page. So if your homeowner has the modification, that's the modification process. Those are the modification documents. But let's say your homeowner did not get approved for HAMP. And the bank has come back and said, sorry, homeowner, you don't qualify. It's not as simple as the bank can just say, sorry, you don't qualify. They need to be more specific than that. So there are some requirements under the HAMP program. The servicers are required to send a non-approval notice to the homeowner. If the homeowner requests it, the bank must send them the MPV data input fields. For those of you that have been on these calls in the past, the MPV, the net present value test, is the determining factor in whether or not a homeowner qualifies for a HAMP modification or not. As you recall, there are a number of factors that go into this MPV data input, into the MPV test. Some of those are homeowner-specific numbers. So the amount of the unpaid principal balance, the value of the house, the income of the homeowner, how far behind the homeowner is, the interest rate for the homeowner's loan, the term of the homeowner's loan. All of those fields that are homeowner-specific, if the homeowner or the homeowner's advocate requests it, the bank must send them a document that lists all of those fields. The idea behind that is that the homeowner or their advocate should have a chance to review and make sure that the homeowner's specific information was entered correctly. I have had cases where it has simply been a typo by somebody at the bank that has caused a homeowner to fail the MPV test. So their income was $3,000 a month, and it was inputted as $300 a month. Those kind of clerical errors happen in this process, and if they do, it should be relatively easy to catch, but without seeing those data input fields, it would be impossible to know. Now, as you recall, part of that MPV test also, there are non-specific homeowner fields. So there are fields regarding what's the likely redefault rate if somebody gets a modification. And the bank gets to decide what that rate is. Now, they have to submit all those numbers to the Treasury Department to get approved so that they are at least in line with reality. But those numbers, we as advocates and homeowners do not have access to. Those will not be included in the data input fields. The only fields you will receive are the ones that are related to the homeowner specifically. If once you receive those data input fields, if you feel that something was entered incorrectly, you or the homeowner have 30 days to challenge any of those inputs. Now, one of the things that's in there is the value of the house. Most of the banks, when they go to find out what the value of a house is currently, they are not going to actually go through a full-blown appraisal. The cost is too high. The process is apparently too cumbersome. So what they often will rely on is BPOs, broker price opinions. If you receive the MPV data input fields and you feel that the value that the house has been given to the house is off, and it is a big number. We talked about, as an example in one of these cases, in one of these webinars, that changing the value of a house from $200,000 to $250,000, in the one example I used, would result in a homeowner going from failing the MPV test to passing it. The value of the house is obviously very important, critical in determining whether or not the homeowner is going to be approved. So if you feel that they have not correctly valued the house, you can challenge that. You can go through a process of getting a appraisal done yourself and getting that submitted to the bank, in which case they will, depending on how that process, depending on what the appraisal says, they very well may have to change that number in the MPV test. And that very well may result in the homeowner passing as a result instead of failing. Again, I want to point out that all of the details of the HAMP program are all available in the MHA Servicer Guidelines, which are available at hmpadmin.com. Again, that is hmpadmin.com. The details of the process of how to challenge an appraisal are all found there. A lot of the questions regarding the non-approval process can also be found there. I'm certainly happy to answer questions, but I also strongly encourage anyone, if you get to that point in the process, take a look at that at the guidelines. They are actually very, I find, very useful and relatively easy to work through. If you have a homeowner that has been denied and you feel that there has been something wrong in the process, there is also an escalation policy, and we're going to go through that in a moment as well. First, I want to show you what the HAMP denial letter looks like. Now, this is a model for the letter. Unlike the approval letter, this is not required of every bank to use this exact document, so you might not get something that looks exactly like this, but it should look similar. And essentially, the reason I put this up there is to show you that if a homeowner is not approved, the bank has to give the specific reason as to why. So some examples. The loan doesn't qualify for HAMP because it doesn't meet some of the very initial requirements we talked about all the way back in our first webinar. The property is ineligible for some reason. Now here on page 2 shows the negative MPV that we talked about. Now again, it goes through right in this letter. It actually talks about how to go about challenging and disputing any of those values, including the appraisal or the property value. So there's information in this letter. There's also further information in those MHA Servicer Guidelines. It may be that it would require excessive forbearance because they can't get you down to 31% without changing the terms of the loan beyond the requirements of the program. So in other words, the homeowner would require 2%, they'd require an extension of 40 years and a balloon payment, and even then, we cannot forbear enough to get them down to where they are supposed to. It may be they had a previous HAMP modification and they fell off it. It may be that they fell off of a trial plan when they were trying to do that. It could be something like the loan was already paid off, so why are you trying to get a HAMP modification in the first place? Now, I will tell you that's one I have never seen before, that the loan has been paid off in full. I'll be very happy to have a client that falls into that category someday. Again, I'm not going to go through every reason here, but there are individual and specific reasons that the bank would offer. So if you get told in a settlement conference, for instance, in Monroe County here in Rochester, we often will have a bank not give us any response until the date of the conference in front of our judge and tell us, sorry, your homeowner was denied for HAMP. And that's all they say. The banks are required to send written denial letters to homeowners regarding the HAMP process. A verbal denial is not enough. Now, again, this is very dependent on the judge or law clerk or referee that you're in front of, but at least here in Monroe County, we have been successful in arguing with our judge that just a verbal denial alone is not enough for it to be removed from settlement conference, that we need to receive that denial letter and have a chance to review those and challenge it if we feel necessary. And our judge locally has agreed with that, and so we'll never take a case out of settlement conference if it's just based off of a verbal denial. Now, again, I understand that dependent on what part of the state you're in, some areas very well may have judges or law clerks that handle it differently, but it certainly is an argument you can make. You can point directly to language within the HAMP guidelines that states that a written denial is required, and that therefore they have not met their burden of good faith under both the HAMP program and under 3408 here in New York, CPLR 3408. Okay, so the HAMP escalation process I want to talk about. There are a number of ways in which to escalate. The first thing that you are asked to do is to escalate within the servicer. If you escalate within the bank servicer, the bank is required to acknowledge that you have escalated within 5 days, and they are required to respond within 30 days. Again, that is according to the HAMP guidelines. Now, again, this is, I guess I have to qualify this, that is theoretical. I know from my own experience that the banks, just like the banks, oftentimes are not meeting their deadlines as far as how quickly they are supposed to review documents or let you know you've sent in documents at the beginning of the process. I've seen the same issues at the end of the process as far as not acknowledging that escalation within 5 days, not responding within 30 days. I think it's very hit or miss depending on what bank you're talking about. And then even within a bank, I think it's somewhat dependent on who has been assigned to the file, who is looking at it at the bank's end. However, that is the first step in the official HAMP escalation process. If you do not receive, and on the HAMP website, they actually go through the escalation process. So the first thing you'll see here is to escalate the case to senior management at the servicer shop. That may not result in you being satisfied that you're getting the answers you need. The next step is these HAMP teams, and that's dependent on who owns the loan. You'll see on the screen here, if it is a non-GSE, so a non-Fannie or Freddie loan, there is the HAMP Solution Center. If it's a Fannie loan or a Freddie loan, there's a specific group within Fannie or Freddie that you're to contact. And again, you'll see on the screen the FHA, VA loans, and USDA loans. There are also specific centers you are to call. Now, I'm guessing that some folks on the call have had experiences with the HAMP Solution Center. And if I had to guess, I would say that not all of them have been completely positive. I know that for us, we have found, again, this process is somewhat hit or miss. I certainly would encourage you to attempt to try it, but I'm also not going to sit here and tell you that all of your problems will most definitely be solved by the HAMP escalation teams. We are somewhat lucky here in New York that we do have a very active Attorney General's office that is very interested in protecting homeowners that are in foreclosure and making sure that the banks live up to the agreements that they have signed off on, both as part of HAMP and as part of the National Mortgage Settlement. So the next steps regard how to escalate through the AG's office, and I'm going to ask Becky Case from our office to talk on that issue. Becky?
Yes. Yes, Kevin, thank you. So just as a note, there are a number of questions that have been presented that might be helpful to go through.
Okay.
Perhaps before we get into the New York City Center for New York City Neighborhood Escalation process?
Absolutely. Sorry, I'm getting it back to the right screen here.
Yeah.
Okay. So do you want to go through those questions?
Sure. So the first question is, do we have any recourse if this trial figure is not the 31% of the GMI?
Yes. If your homeowner receives a trial modification and you feel that that payment is not that 31%, and I'm going to guess likely that the only time you would argue is if the number is higher than 31%. If it's lower, I think the homeowner is going to be very happy with that, so they're not going to challenge that. If it is higher, I would contact the bank immediately upon receipt of that to go through the numbers that they have used in qualifying the homeowner. I have had cases where we've had issues with that. We have raised it with the servicer and been able to get that taken care of right then and there. If you can't get any satisfaction from the servicer and they're still claiming that these are the correct numbers, I would then escalate to the HAMP escalation team, the HAMP escalation group, to determine if they can help you in the next steps. Also, depending on who that bank is, that also may be something that can be addressed with the AG's office or CMYCN.
Let's do this one. The homeowner has to request the NPV data input fields, or are they automatically provided if denied? Does the homeowner want the value of the house to be highballed or lowballed?
I believe, and if I may be wrong on this, but I believe that the homeowner does have to request those NPV inputs, that it is not automatically sent to you. So they would need to request those. As far as what they want the value of the house to be, the higher the value of the house, the harder it will be to pass the NPV test. So a lower value will give them a better chance of qualifying.
Yes. All right. And the next one is related. It would seem that the value of the premises and our own appraisal could affect the excessive forbearance denials. Have you been successful on changing HAMP due to the denial due to excessive forbearance? Not quite sure I understand.
Well, I think Joe was I think saying, have you been successful in challenging HAMP?
Yeah.
Due to the denial of excessive forbearance. Again, I do think you're right that it comes back to what the value of the house is. So yes, we have we have seen successful challenges of the value of the house. So I do think that it is possible. That's the short answer to that.
Okay, and this one is somewhat related as well as the previous question. Is the bank required to disclose data input fields for loan mod denials for GSE loans for Fannie, Freddie, and FHA?
Diane, that's a very good question. My gut answer is that yes, they do, but I will confirm that, and I will make sure that we send a follow-up email to the group with an answer to that question, because I think it is important, and I can't tell you with 100% certainty that that's correct, but I believe that it is the same process.
Okay, and then one more for now. The signature is only applicable for HAMP mods, not FHA or bank non-HAMP mods, or is this applicable for all mods? And it's referring to the signature that's required by a divorced spouse who has signed over their interest to the other spouse living in the house.
That is correct. It is for HAMP modifications only. So if your homeowner receives an in-house modification, let's say your homeowner does not qualify for a HAMP mod, and then the bank looks to an in-house modification, the banks, I have seen cases where the banks will say, unless both parties will sign, we will not allow it. Now that is very much bank dependent, but the language that I pointed to is specifically for HAMP modifications.
All right, that's all we have for now then.
Okay.
So all right, let's move then into the escalation part of things. So with HOPP, which most, if not all of you on the phone are recipient of HOPP, then you have an opportunity to escalate to other places outside of the lenders. One of them is you have a violation of the national mortgage settlement. Those violations are getting requested from Dina Levy at the Attorney General's office, and she is very specifically asking for those violations to be sent, not only in the data points, but then also still continuing to be sent to her for Wells Fargo and Bank of America and any of the 5 lenders who are part of the national mortgage settlement. The next escalation is specifically for New York through this HOPP program. There is a program that's run by Center for New York City Neighborhoods that the name on the screen is no longer the person that you should be talking to on it. Briefly, what it is for those of you who are in New York City, you are a little bit more familiar with this program, but it's an opportunity for housing counselors to escalate their case. So when they believe that, oh, Kevin, I can see what you're doing. There we go. So when housing counselors are struggling with a case and they believe that they have gone as high up as they can with the case and they believe that the lender is doing something wrong, so they're not following the guidelines, they're not following the PSA, the pooling and servicing agreement. If there's something that they think the lender has done wrong, there is an opportunity for housing counselors to escalate that to Center for New York City Neighborhoods, and there's a form that they would fill out, which will be in a moment in the next page. The person that you should be contacting for that, though, is not Tadeo Johnson. It is actually Candy Bell, and I'm not going to be able to pronounce her last name correctly, so I'm just going to spell it. But her first name is Candybelle, and last name is Acevedo. And I apologize if we don't have that on the screen for you. Her telephone number is 646-786-0891, and her email address is her first name, period, last name, which again I'll spell Candybelle, period, Acevedo at cnycn.org. Okay, so she's the person that for housing counselors, you should be directly contacting Candy Bell and using the form that's on the next page, we'll show you in a moment. For those of you who are in litigation, the lawyers who have the ethical obligation of not speaking directly to the lender, you cannot use Candy Bell. You have to go through Adam Cohen at the Office of the Attorney General's office, and his email address is on the screen in front of you as well. But what Adam will be able to do is the same thing that Center for New York City Neighborhoods can do, but because he's with the AG, it allows us a workaround with our ethical obligations to speak directly to the lawyers on the other side. Okay, so, and then the next one is the bank in-house escalations. Kevin, I believe you touched on that already, correct?
Correct.
Okay, so can you go to the next page for me? Okay, so again, when to escalate, this is when the application is taking longer than it should be, so taking more than 90 days for it to be processed. You're getting the runaround, so either the paperwork is getting lost, you're getting inconsistent answers where you pick up the phone and every time you talk to them they give you a different answer or a different reason as to why the person's getting denied. That's not helpful, and you need to find out what the real reason is, because quite frankly, if they're giving you multiple reasons, that might just mean that none of them are legitimate answers. The modification terms are not clearly spelled out. You can't get an answer as to what your client is actually agreeing to. So that wouldn't necessarily happen in a HAMP mod. They're pretty clearly laid out for you. But in in-house mods, that can happen. And then if the waterfall steps are getting skipped or not applied, or as I said before, if any of these guidelines that Kevin has spent, this is now the 4th webinar talking about how to pursue loss mitigation and loan modification options. If any of those guidelines that he's talked about has not been followed, FHA or whatnot, this is the opportunity to escalate that to somebody who has some authority to talk to someone at the bank that is able to look beyond that screen shot that they seem to be only able to look at when they're talking to you.
And I'm just going to put a plug in here for the AG's office, because I know that Empire Justice Center, we had a lot of cases that we had submitted to the AG's office as part of their gathering issues with the banks that signed on as part of the National Mortgage Settlement. Also have cases that we've gone through ADAM on, and we've had some real success stories for our clients as a direct result of those escalations. So I know in the past we have had times where we've had different escalation points within different entities that have not really gotten us anywhere. This is definitely not one of those cases. I really speak very highly of that process, and I think it can be very effective. So.
Yeah. Okay, can you go to the next screen? All right, so this is the form that you're going to use. It's a snapshot of an Excel spreadsheet that when you're escalating it to Center for New York City Neighborhoods to Candy Bell, this is the document that you're filling in. And actually, when you have the full spreadsheet, there are multiple worksheets. So there's instructions on the first worksheet. There's the actual form that you're going to fill in about the loan. There's a couple of the entire worksheet in its entirety is quite helpful. So I just want you to see a picture of it. And this is the form that you fill in if you're escalating it to Adam at the AG's office. Essentially, it's the basic complaint form that all consumers would use to fill in for any type of complaint. So it's not something that is tailored for our issues, but essentially what you will be doing is submitting a written document with all of the supporting documentation that you can offer and that you can provide to help make your story and your case clear so that the AG's office can run with it. And as Kevin said, the easier you make it for the Attorney General to see why there's a problem and why it's so simple to address, the more likely it is that your client is going to see results.
Now, Becky, if folks on the call want to get these forms, the actual forms themselves, and not just snapshots from this PowerPoint, is there an easy way for them to get those forms?
Well, so this form is actually online. You can get this from the Attorney General's office for the Consumer Complaints form, and then the Center for New York City Neighborhoods form, that's been sent out on several occasions, I believe, perhaps several months ago. So if you don't have it for some reason, you can contact me directly, and I'm happy to forward it along. Or, actually, what might be better is for you to reach out to your anchor partner representative. So if you're in upstate, it could be either me, Maria, or Ellie. If you're downstate, contact folks at Center for New York City Neighborhoods. I assume if you're downstate, you're more familiar with the form.
Great. Thank you very much, Becky. The last suggestion we have regarding of how to handle issues when you have issues you want to escalate or you're not quite sure where to go. We are very lucky here in New York in that we've got a lot of really smart folks that have done this work for a long time throughout the state, and they're all pretty willing to work with each other and help share best practices and helpful hints. So I would strongly encourage folks on the call to reach out to your anchor partner or to your peers when you have questions. There are some great email listservs that are statewide that I know people, some of the people on the call I've seen use, and I know I've used myself and have been able to get some really good ideas that I would not have thought of or were not aware of otherwise. So I certainly would encourage you to utilize the information that your peers have, because there's a lot of it out there. Last thing I want to look at today, we want to go through, is if you have a non-HAMP loan modification, so an in-house modification for a homeowner. Becky talked about the fact that some of the terms sometimes is not completely clear what some of the terms are or kind of what to look for. Because it's in-house, each bank can come up with forms and documents that really they're all over the board as far as how they look. We can't give you one example of what the form will look like, what the letters and the documents look like. But there are some very important things that you should look for and make sure that you have a full understanding and the homeowner has a full understanding of. First thing is the term, to make sure that if they, let's say it's a 30-year mortgage and they're 15 years in, under the new modification, do they still have just 15 years left, or has that term been extended? I've had cases where the bank tried to extend the term. They were not exactly clear in stating that. It was buried in the document somewhere, and so the homeowner obviously very important for the homeowner to know that, no, this isn't going to be your payment for the next 15 years. This is the next payment for your next 30 years. The total amount capitalized. So we talked about the fact that if they do a modification, typically what they do is they take all of your missed payments, any taxes or insurance the bank paid on your behalf, court costs, attorney's fees. They take all of that, they add it onto the principal balance and spread it out over the course of the remaining years of the mortgage. That amount that is added onto the principal balance is called the capitalized amount. What the banks will often do is give you a big, just one number of, okay, we've capitalized $18,226, but no further breakdown of the capitalization. What I would recommend, what we do in every modification that we have that's non-HAMP, is a breakdown of what goes into that capitalization. We're going to go through an example of that in a minute if we have time to go through that. Next thing is the new unpaid principal balance. Again, you want to confirm that the old principal balance plus the capitalization equals the new principal balance. Believe it or not, and I'm sure people on the call do because you probably have had similar things happen. I've had cases where those numbers did not add up. So the old principal balance was $100,000, the capitalization was $25,000, and they said the new principal balance was $150,000. That is a very simple and obvious issue, but it can be the case where it never gets caught. The homeowner, oftentimes with our clients, they are so excited to be getting a modification. They've gotten the documents. The payment is affordable. This long nightmare of a journey they've had in foreclosure now looks like it's going to be over. And so the homeowners really are ready to sign anything. That's fine. I'll pay that. Sure, I can afford it. They are oftentimes not looking with a critical eye at every one of these numbers. Now, some of the homeowners obviously will, but I know some of the clients I've worked with would have signed anything I put in front of them if it meant they could save their house. So I feel it is absolutely imperative in my job as their advocate to make sure that the numbers are correct, they're accurate, and that we at least understand what they are. Because the homeowner, again, once they sign that modification, it's a legally binding contract that says, I agree, I owe this amount, and fighting it after the fact is extremely difficult. The new monthly principal and interest payment, as well as the new monthly principal, interest, and taxes and insurance payment, the PITI payment. One of the things here that I do, I've got a simple mortgage calculator that I downloaded from the internet. There are hundreds of them available online. What I will do is go in, and a lot of these calculators, what they do is essentially there's 4 terms to a mortgage. There is the principal balance, there's the term, there's the monthly payment, and there is the interest rate. If you know 3 of those 4 values, you can automatically calculate the 4th. So what I will do is I will go in and I will say, okay, here's my new principal balance. Here's the remaining term of the mortgage, and here's what the bank is claiming the interest rate is. Does that equal the monthly principal and interest payment that the bank is claiming? We have had several cases where the bank has simply messed up the amortization schedule, and so the payment amounts are incorrect. It's a black and white issue. Their math was wrong. Again, and where we have seen that happen recently on a number of occasions is some of these smaller servicers that oftentimes have bought distressed loans, probably for pennies on the dollar, and now they're trying to modify them. And I think they're smaller units. They don't have those quality controls in place, and so documents can go out with terms that are incredibly wrong. Again, without the advocate making sure and following up on these, homeowners can get lost in that process and just say, well, I got to sign it, I got to sign it, I got to save my house. It's kind of the figurative gun to their head. So I do think it's incredibly important for the advocates to take a look at that. Other payment information, so this would be things like, where's the payment supposed to be sent? What's the date it has to be received on? Is there still a grace period? That's often a big thing for the clients that I work with because they do not have They oftentimes are living paycheck to paycheck, and so they may say, you know, I know the payment's due on the 1st, but I always get it there on the 6th. We want to make sure that they still have that 15-day grace period or whatever the case is. You want to make sure it is very clear where the homeowner is supposed to send their payments. You would think something that important would be on the first page in bold, but oftentimes it is buried in the back of the document in small print. I make sure to circle and highlight that so the homeowner has an exact record of where they're going to send this payment. The status of the foreclosure action, this is important that the bank, once they do a modification, that they are going to file a discontinuance with the courts to withdraw the foreclosure and withdraw the lis pendens. It very well may not be in the modification document itself, but it is something to make sure to follow up with the bank or the bank's attorneys that is going to happen as part of this process. Okay, I want to look quickly, we only have a couple of minutes, but I want to look quickly at a real-world example that we had regarding, we had asked for a breakdown. Again, in-house modifications oftentimes are where we see the biggest issue of banks sending out documents and then requesting modification documents and then requesting that the homeowner return them within 24 or 48 hours. And these are the cases that we often have issues with the capitalization amounts. Again, my advice, get on the phone as soon as you have these and let the bank and the bank's attorney know that you have questions regarding the capitalization amounts. Therefore, you are not going to have the documents back by the date that they have requested because you need time to review them. I have had a lot of success with that in getting banks to give us more time. In this case, we had asked the bank to provide us a break. Actually, this letter you're looking at was included in the cover with the actual modification documents. And so you can see that they listed here the amounts to be capitalized. They say here's what the interest was, the corporate advances, the escrow shortage, other capitalized amounts, and so they came to a total capitalization of this amount. We wanted a little bit further information as far as what went into that other capitalized amount, what went into the escrow shortage, what these corporate advances were. So we asked the bank attorneys for a breakdown. Here's what the bank attorneys provided to us. Now you can see it's in a much different format, and the numbers are different. So if we go back and forth, here we've got taxes and insurance and a total escrow advance balance of $32.14. Well, if I go up here, escrow shortage is $48.76, corporate advances is $25.68. Neither of those amounts really match up to what they're showing us on this page. In addition, you show attorney's fees of $31.13. That number is not listed anywhere here. All the numbers were different. So we now have two breakdowns, one provided by the attorney, one provided by the attorney by the attorney's client, the bank, and the numbers are all over the place. And so we had no confidence that what we were going to have the homeowner sign was accurate. What it required was a number of phone calls and a number of discussions with the bank attorneys. They ended up getting someone from the bank on the phone with us to go through it. In this case, at the end of the day, the numbers actually did make sense. They were put into different formats, a little bit different buckets, but once they gave us a complete explanation, I felt comfortable that the modification documents were accurate and we could allow the homeowner to sign. It did take an extra 2 weeks, and so we did need to have that extra time. Now, I will say, this is a part of the process that I think is incredibly dependent on the homeowner. And the reason I say that is that I've worked with some homeowners who will say, I absolutely want to fight the bank for every dollar we can. I don't, I'm not going to sign on for a penny more than what you think I owe. And I get that. I've also had homeowners that have said, listen, I know that we may be getting the raw end of the deal a little bit here. With classic cases, attorney's fees. So the banks are charging, let's say in Rochester, typical flat fee for a bank attorney for a foreclosure is somewhere between $2,500 and $3,500. And I know that may seem low to folks that are in the downstate area, but that is in Rochester what we typically see. So if we have a bank that comes in, a bank attorney that comes in and tries to charge $10,000, we very well may be able to fight those attorney's fees and say they're excessive. But what it's going to require is that the homeowner is not going to sign the documents on the date that they are due by, and in fact, it may take quite a while to complete that challenge. I've had homeowners that have said, you know what, I'll hold my nose and sign it. I've been in foreclosure for 2.5 years. It has been a hellacious process. I just want it behind me. And I completely understand where they're coming from. And in that case, obviously, either way, the client has to be the one that drives the bus. I will give them my opinion as to what I think is possible. Here are the potential risks involved. But at the end of the day, it's going to be the homeowner's decision. It's their house, and each homeowner does have a different and unique perspective on that. So I think it's important that while we advocate on behalf of our clients, at the end of the day, it's about the client's the client's wishes, and so we have to let them make the final decision on how hard we challenge, how far we push. Okay, there is an example here of a non-HAMP loan modification. I think it's somewhat self-explanatory. It does have all of those things that we talked about as far as looking for them. If you go through that and you have questions, please feel free to follow up directly. You'll see on the screen my email address and my phone number. We are bumping up here against 1 o'clock, so I'm going to cut it off there. Michelle, we do have the, for CLE purposes, we've put that up on the screen. Do you need to announce that?
Yep, the CLE code for today is 493821. It's all numerical, 493821. So just write that code on your form and get it to me, and we'll issue the credit.
Thank you very much. Becky, do you have anything to add at this point?
No, there's a couple of questions, but I think that they've been answered by you throughout the process, so I think we're okay.
Okay, great. Folks, I very much appreciate your time on this webinar and the other 3 that we've done. If you have questions, if anything wasn't clear, it's probably my fault, not yours. Please follow up with me with questions that you have either on the phone or via email. I'm happy to help, and if I don't know the answers, try to reach out to folks that do. I hope you all have a great day, and thanks so much again for attending.
Thanks, everyone.